Hi, Trey Booth here with another educational vlog from Five Plan Partners. And today I want to talk about the inflation and the price to earnings ratio of the S&P 500. Inflation has been in the news for the past few years, and there's been no doubt that it's impacting equities and in the direction of the stock market, the direction of the bond market. But today I wanted to look at how does it relate to the price to earnings ratio, and how can that tell us where we think the market may go from here. First off, let me just explain what the price to earnings ratio is. So the price to earnings ratio is the price of the market. So let's say the S&P 500, which for an easy round number, let's say is 5,000. And then that price over the earnings, which let's say for easy math is $250. So the total earnings of all the 500 companies added together gives you $250 a year. The price to earnings ratio of the market in that situation would be 5,000 over 250, or a PE ratio of 20. That means that investors are willing to pay $20 for every single dollar of earnings. And so the more optimistic investors are, the more they're willing to pay for a single dollar of earnings. And so the higher the PE, the more upside there is in the market. And so what this chart shows is that different rates of inflation, what was the price to earnings ratio of the market in those ranges. And you can see a clear indication here that the higher the rate of inflation, the less investors are willing to pay for each dollar of earnings. And that makes sense because in a high inflationary environment, a dollar is worth less and a future dollar is worth even less. So you can see here that the best time period is between 0 and 2% inflation, which lines up with the Federal Reserve's target. The Fed targets that 2% inflation range. That's not too cold, so we're not dealing with deflation, which you can see the PE starts to go back down when you're dealing with deflation. But it's not too hot where prices are going up at a rapid rate and people aren't willing to pay today for a dollar tomorrow. So as you can see here, there are pretty important ranges. And so we use this as an indication of where inflation is, where we expect inflation to be, and then we back into, based on those expectations, how much are we willing to pay for a dollar of earnings? And based on that, is the market over or undervalued based on where we see earnings, where we see inflation? So this is a very important indicator for us for long term. This isn't very helpful in terms of day trading, but in terms of long-term investing, it's very important to understand where inflation expectations will be down the road, and that helps us price in how valuable those earnings are down the road as well. I hope you found this information helpful. Please give us a call or shoot us an email if you have any questions. We'd love to talk more about it with you.